to the Capital Discussions Roundtable. I'm Tom Nunnermaker with Jim Reggio and our guest, Amy Meissner. Before we get started, we have a quick disclaimer. The Capital Discussions is not a broker-dealer or an investment advisor. The presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical or simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And with that out of the way, welcome back, Amy. I'll pass the ball to you. And
Tom, before you pass the ball, would you just pull up Amy's performance on the website? Just like to end up review real quick and see how she's done, and you and I talk a little bit.
Let's see here. So on all the experts, we have the trade history tab, which has the equity growth chart. And Amy doesn't have some of the numbers the other experts have because she hasn't had any losses yet. So you can't compute things like expectancy or Sortino ratios. But a nice, smooth equity growth chart, which is exactly what the Weirdor gives you, is looking great, Amy.
Oh, thanks. Actually, I almost was looking to get out of the June trade a little early, and tried to get out of it today, but with no luck. So that's why there's nothing. The June trade's still open, but it's getting close.
I think I saw on your update about 5%.
Yeah, it's up about 5%, something like that. Yeah.
Okay. Well, it's another good month.
I'll have to double check. I can take a look at it now if you want me to just show the graph real quick.
Well, you've got the ball, so you can share your screen and pull up what you want.
Oh, okay. But, yeah, I know Jim wants to get to the questions, but we can answer that real quick. Am I sharing my desktop? You can see me?
I can. Thanks for using WebEx.
All right, there we go. Yeah, so just real quick, it's up about almost 5%. But, yeah, it should be looking to get out of that pretty soon, so it's doing very well. So hopefully I'll be able to squeeze out a little bit more out of it.
It's looking great for 4.
Good. So
you know what I wanted to end up talking about, and the reason why. Hey, I'm sorry, Amy. Were you going to add anything else?
Nope, that was it. I was just passing the ball back to you guys.
Okay. You know, one of the things that you saw with Amy's trades, that they were pretty consistent. You know, she hasn't had a loss yet, but it's because a lot of ways she ends up doing, you know, her money management. When I take a look at the single biggest challenge that I see most retail traders have, it's that they don't find what I would call, or Amy, I don't know if you use the same term, but they don't find their comfort zone. And here's how I define their comfort zone. Their comfort zone is knowing how much risk they'll take, their risk management, versus when they'll do their trades. What I find with most clients or most retail traders is that they'll either overtrade, meaning that as soon as things start to end up moving a little bit against them, they're watching the machine constantly. As soon as it gets out of, the tightest little range, they'll make a trade. And then what happens as soon as they make it, it ends up going in the opposite direction. And then they'll make an immediate change to undo what they just did. And what happens is they get whipsawed. Okay. The other thing that ends up happening is that they'll say, well, I'm willing to end up taking this level of risk. But if they end up getting to a certain level, then they think, well, the market's moved up, 6 days in a row. It's got to pull back right now. So I'm just going to end up waiting. And it goes up, the next day and the day after and the day after. And now they're outside of their range, and they've waited too long. And so what ends up happening is that how do you get to your comfort zone, knowing here's the way I'm going to manage my risk, and then having the discipline to end up making those trades when you need to make those. Amy and I have talked about this, and one of the things that I wanted Amy to end up sharing was that, Amy, you've obviously gotten to your own comfort zone with the Weirdor. Could you kind of give us an idea about, where your risk level is and how you ended up approaching and how you solved that very, very difficult problem that I think every retail trader initially faces?
Yeah, sure. So basically, I've been, I'm in the camp of, making money for a living doing this options trading. And I put very little money towards anything speculative. So my goal in trying to make a living doing this, or actually, being successful at it, has been to work on making my trades as, forgiving as possible, but trying to get to the point of, consistent profits, high probability, but keeping the losses really small. And, so that way, obviously I'm making money over time and I'm not getting hammered every once in a while and then having to play catch up. So the Weirdor, let me go into, there we go. The Weirdor trade, let me get that over there. I have a little presentation there, not much of one, but something. Anyway, so the Weirdor trade, basically, thanks Tom for making these graphs for me.
No problem.
The whole point of it was to try to, I've been trading a lot of the condors over the years and double diagonals and things like that, all high probability trades. And the Weirdor, one of the reasons why I really like that is it kind of smooths out the space, just as an example, the blue line. It's basically trying to show here that it's allowing, the whole point of it is to try to have a very smooth equity growth chart where there's a continual move upwards. It's not like I'm trying to hit a home run every month. I'm just trying to make consistent income. And the down moves are small and infrequent, as opposed to this yellow line, which might be a bit of an exaggeration. Certainly isn't any strategy that I've traded. I'd be pretty frightened of it. But this could represent something like, an index like the S&P 500 or just something that's kind of choppy over time, and you have to, like for instance, you have these nice big up moves, but then you also have some substantial down moves, and eventually, hopefully, it'll all kind of, heading up into a profit zone, but you have a lot of headache along the way. So the Weirdor was kind of like, how do I get this thing smoothed out as possible, and how do I trade it so that I can have it, the losses being smaller than the wins, or certainly not being any larger and being infrequent. So in doing that, obviously I've had to find, like what you said, my comfort zone in risk management. And I've always been in the camp of, definitely the name of the game in trading is risk management. Yes, it's about making money, but the most important thing is about risk management. And if you think about all it is like profit, 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 and don't think about managing your risk while trying to make that, you're kind of missing the point, I think. So to me, the whole name of the game is risk management, and doing it in such a way where you're actually managing your risk so that it's not going to hopefully blow up your account if something happens, but also that you're not over trading, which is all the opposite spectrum of what's going on with some people. So it's either people have the tendency to take that deer in the headlights look with like, oh my God, here comes this racing train at me. I don't know what to do, and they don't do anything, and then you kind of hope that it turns in the other direction, and that becomes more of a directional trade. Or you take the other camp where you're constantly trying to flatten out the deltas, and it becomes so many adjustments going on that you overtrade it and you lose the ability to actually make money from the trade. So it's kind of like, where's the middle ground to making sure that the adjustments are made in a timely manner, but not overtrading them to the point of losing the ability to even make money in the trade. So that's kind of what I've done with this, and I think one of the ways that I do it is obviously I'm watching it every day, but not constantly, not like minute by minute, with the fluctuations, and obviously there's going to be different fluctuations based on the underlying moving and based on the IVs changing, and sometimes the T+0 line is going to kind of bop up and down a little bit, throughout the day, and it might look like, oh wow, I just made a bumped up $100, and then all of a sudden now it looks like I'm down 50. So it's not the type of trade that you want to watch it, constantly, like a day trading type thing. It's definitely something to pay attention to on a daily basis, but not as a day trader watching it constantly every minute. So hopefully that kind of gives an idea of answers your question about my comfort zone.
Amy, it's what I end up seeing, and the really harsh reality, okay, that a lot of retail traders don't know. Here's a big secret that to me is very, very obvious, but people don't walk away with. When you make your adjustment is a lot more important than, your specific adjustments. I mean, and that's to, a reasonably qualified trader, right? I mean, I'm not saying making stupid adjustments, but, do I end up choosing this strike, or do I go 5, do I go down 5 more points? If I have 20 contracts on and you're supposed to roll off, let's say, half of them. If I do 10 or if I do 12, that's not going to end up making nearly as much difference than if you waited 3 days and it moved against you.
Exactly. Okay. And I think that, through experience, you do kind of get a feel, especially with whatever strategy you're working on. And in this case, I do have a feel for, if I do an adjustment closer to the money as further away, which one's probably going to work out better for me. But I definitely, when I do an adjustment, I look at a couple things. I mean, one is making sure that I do it in a timely manner to where, give it enough wiggle room, so that I'm not killing the trade, but I'm adjusting it so that it can flatten it out to the point where I'm not hoping for a certain direction. So you don't want to turn this into a trade where, whether you do the adjustments late or early or too many times or whatever it is, you never want to turn the trade into something where you're hoping for a certain direction in order for it to work out. So, and a lot of times that's more of, like you said, a timing thing, as opposed to picking exactly which strike is going to be better. That exactly which strike, or in certain situations, is more of you just kind of get a feel for the trade over time and the experience of which one might work out better. But because of, if you go further out of the money, obviously, it might help you right away. It might flatten out your deltas right away, but it's going to, over time, not be as beneficial, like, let's say, on a downside move, putting on a put-debit spread and putting it out further away from the money. Maybe I'll lose more on one that's closer to the money, but on one further out of the money, it might not help me very much. So, there's little things like that you kind of learn over time, which ones might be better in certain situations. But overall, the effect should be the same. Don't put something on that's going to, or not do something that's going to turn the trade into a directional trade.
Now, that kind of leads into the second biggest issue that I end up seeing. And, we talk about the timing and when to put the trade on. So what ends up happening a lot of times is retail traders will end up asking, okay, so give me specific rules of when to end up making the trade and how I should end up doing it, which, Amy, the thing is that the amount of risk and the adjustments that you're going to end up making are different at different points in the trade, right, with how many days to expiration or what volatility levels are. How do you take those into consideration when you're doing your risk management?
Well, I actually put together, because I put together something to kind of show that a little bit, a little slideshow, and I have to say I apologize to everybody. I have 2 dogs who decided to take this time to have a wrestling match right behind me, so I apologize if there's lots of shuffling in the background. That's my puppy playing.
It's like they know. No.
I'm sorry, what?
I said it's kind of like they know when you're on the phone. This is the time that they can mess around because Mom won't be watching them.
Yeah, well, at least they're not barking, but I probably shouldn't have said that because I'm asking for it now. Anyway, so I apologize if that's making a little bit of noise, a little distracting for anybody. But so let's go into that. And this so what I did was I kind of put together a quick little slideshow, because we had talked about this before, about how I would show how my comfort zone kind of changes throughout the trade of, where to put these possible adjustment points before making not the actual adjustment itself, but, where would it be, where would it lie within the trade that I would even want to look at doing an adjustment. So I'm going to go through that. Let's see here. If I can, why is this not working? That's just the same disclaimer that you guys talked about. So I've got a couple of examples. So what I've done here is I put together, and I apologize, these aren't, I'm not an artist or anything, and I put it together pretty quickly, so the graph should kind of line up, but it's not super pretty, so hopefully you guys can get the gist of it, though. So here's a Weirdor, like at the beginning, the very first day of the Weirdor. So at the beginning of the trade, like what you were talking about is, the main thing that is really, they're not really long-term trades. I'm not putting them on 60, 70 days out. I'm putting them on, like 45 days out or something like that, 40, 45 days, maybe 50 at the most, something like that. But there's enough time to get a good premium and get far outside of the of where the in this case the Russell is, far out of the money. But the time premium comes out of it pretty quickly, and so it allows me to make changes to my adjustments based on how the time premium is starting to, the theta is starting to come into the trade. And of course IV also, volatility is also going to make a difference as well. Obviously the volatility is going to go up when the market goes down and go down when the market goes up, but sometimes it chops around a little bit. If it doesn't move too fast, it's not going to do that much. But really the volatility doesn't hurt as much, it hurts more in the beginning of the trade than towards the end of the trade. It really doesn't do much. But it's something that I expect. So I'll see, like, for instance, this little, represents the T+0 line, today's date, and this represents the expiration date here on the graph. And so this T+0 line will obviously kind of pop up and down based on volatility, but I'm not as concerned about that because I'm going to be making adjustments, in a early enough fashion, depending on where it goes, so that it doesn't affect the trade too much. So basically, here is the beginning of a Weirdor. Excuse me, hold on one second. Be quiet. Sorry about that. Puppy has to bark. So what I'm showing here is at the beginning of the trade, I'm giving it probably about equal wiggle room on each side. So, I'm willing to take a little bit of a loss before, doing any kind of an adjustment. And of course, if it gets to those adjustment points, I'll take a look and see, what should I do? What's a better option to do, that kind of thing. That's going to give me, where is it at that time? And just get something done so that I can fix the trade a little bit. I'm not really concerned about the expiration line because the T+0 line in this particular trade will, generally from this area to this area, it'll pop up above the expiration line. So I'm never really worried about putting on an adjustment where my, especially the right side of the graph, kind of drops down. It's more of looking at the expiration or the T+0 line and then the target exit date line of where I think where the trade will be at the time I want to target exit this, which is generally, I certainly don't take it into expiration, usually a couple weeks or more before expiration. So you see here it's pretty equidistant. On the next slide, as you can see, this is only 1 week into the trade, and already there's quite a bit of theta captured. And so at this point, I'm moving out my adjustment to a much higher level. So I'm not really going to look at this. I'm still willing to let it, give it a little bit more breathing room and let it roam around a little bit before I have to make an adjustment. Because every time I make an adjustment, I'm obviously taking out a possibility of profit out of the trade. So if I don't have to, I don't want to. But if I need to, I'm going to do it. So this because of this not being a very long-term trade, it's already gaining theta in this case. Then you see the next graph. It's kind of hard to tell, but in the next graph, I kind of keep my downside adjustment around the same, so I don't want to lose any more money. I could bring it out a little bit further, And then on the upside, it's kind of hard to tell, but I actually do that a little bit, maybe 5 points or so, a little bit more breathing room. I'll give it like another 5 or 10 points. That's the second week in the trade. And then here's the third week in the trade, and this particular one this is actually based on a real example. There were no adjustments, so the theta really kicked in. I didn't have any adjustments that were taking any profit out of the trade. So at this point, even though it was only 3 weeks in the trade, and I think about a week and a half before my target exit date, actually it was getting up there. There's still more money to make in the trade because, especially in this area over here, you can see my cursor kind of wiggling around here. The T plus airline tends to pop up above that, but it's getting kind of close to the right side of the graph, where, as you can see, I've tightened the adjustment points. So if you go back, now I'm coming in to my put adjustment. Now I'm saying I don't want it to go over here. If I get over here, maybe I'll just get out of the trade, or maybe I'll do an adjustment. And then you can see here as well on the call, it's over here, and then if you can kind of tell, it kind of squeezes in. I don't want it to go up much further because that's going to take money out of the trade, because I'm going to be losing money on a couple of the spreads. So I kind of tighten it at that point, wanting to keep as much profit as possible. So if we look at this graph right here, what this is showing, I'm trying to show this. Our option view does a better job of this. One, I have to have 2 separate graphs. So the top one is kind of showing what the one was before, the 3 weeks in the trade, 1 day before close. And then I'm going to say, okay, well, if I were to keep it to the target exit date, which is about, in this case, another, I think, week or week and a half, what am I going to expect then? So as you can see here, this little dashed line kind of shows that at that particular day of the trade, I'm pretty flat. My deltas are pretty flat, and I have some wiggle room between here and here where I'm not really going to lose much on the trade or gain much, and I can, have a nice profit. But if I wait until my target exit date, I can make more profit if the rut goes down. But as you can see, this kind of slants down. I might be losing what profit I have now, or giving a little bit back if the rut goes up. So that's why I kind of moved my alert for an adjustment, or possibly just taking it off at this point closer, because I don't want to wait to turn this into a directional trade, and that's not a very big slant. I mean, right there. So because I'm trying to keep it as flat as possible, but it does make a difference, especially if you're doing multiple tranches, like 100 tranches or something like that. It makes quite a bit of difference in dollars. So those are the kinds of things that I look at, and in this particular case, I did close it the next day because it didn't pay for me to stay in and hope that it was going to, pull back. There was just no reason to stay into it. So that's kind of a good example, I think, I hope, of starting out, being pretty, giving some wiggle room, but making sure I do a timely adjustment, giving it more wiggle room as theta gets into the trade, shrinking it down a little bit in certain areas depending on where I'm at, and then finally really shrinking down the window when I'm getting close to realizing most of the profit that I want to have. And then I'm sure, I put up another example here. Okay, that was real simple because there were no adjustments on that one. But, I put up another example. This one did have an adjustment. So again, pretty equidistant on the beginning of the trade, widening it out as a week into the trade. And this is even after an upside adjustment. So as you can see, it's still pretty flat, but I'm giving it some more wiggle room. On the upside, Amy, on the downside, I'm not.
Could you tell us how you widened it out?
How do I what?
You said you widened the trade out. Could you give us an example?
Oh, I don't widen it. I just widen I don't widen the trade. I'm sorry. What I meant was I widened the alert points of my adjustment points. So, maybe I start off, let's go back here. Maybe I start, I don't know what that price is, but let's just, for an example, let's say this was $12.50. I know that's not, I don't know what it was. But let's just say it was $12.50 where the rut was right now, and maybe this is, $12.60 or $12.70, and this is, $12.80 whatever. Let's say this is 1260, just do 10 points. Let's say this is 1250. I'm allowing it 10 or 15 points up, and I'm allowing it 10 or 15 points down. Then the next week, I'm allowing it even more points up and down. So what I meant by widening is widening my my area of, giving it more room before I do something. I'm not widening the trade. I'm just widening the area of letting the rut kind of move around in that area. So instead of making an adjustment here in the next week, I'm not going to make an adjustment here. Now I'm going to wait for it to get down here. That's what I meant.
And Rick Van Buren asked, is it subjective, or how do you actually end up setting those points?
Part of it is, it is kind of subjective. I just kind of eyeball it. Obviously, this is going to, if the rut moves down here, the volatility is going to go up. So this graph, this T plus 0, is going to be popped down a little bit. And if it moves up to here, it might pop up a little bit because the volatility comes out. So it's not going to look exactly like this if it gets to one of these adjustment points. That's why I set an alert and I look at it and see what's the best option to do. But it's a good, in this particular case, it's like, well, maybe I'll have a small loss if it, the volatility pops a lot, if it gets down there really quick. But, it's certainly nothing, I don't want it to get to the, it's kind of like, I don't want it to get to the point of, if I wait too long to make an adjustment, like let's say I waited down here, over here, to make an adjustment. I'm already in a slope, I think Dan Harvey likes to call it the slippery slope. I'm already in a slope of hoping that it goes back up. So if I make an adjustment way down here, it might flatten my deltas, but it's not flattening them enough to keep me out of trouble in the trade if it continues to go down, that it becomes a trade that I'm hoping that it's going to go up. If I flatten them out over here, like for instance, let's look at example 2. Well, this one went up. But, so I flattened it. So it came here. It's, if I waited until here, it's, it's already kind of too late. If I do it here, it flattens it out. And in this case, it also moved a little bit back, not too much. Okay, don't kill each other, guys. But you can see here this, because of the theta that's back in the trade, a little bit of volatility out of the trade, and the adjustment I made, now I'm still, I still have lots of profit left in the trade, but I flatten it out a bit. It's not, you don't want to get to the point where you wait so long to make an adjustment that making the adjustment doesn't really do any good for the trade either. And then on the other side, flip side, of course, you don't want to, like for instance, let's say I only let it go here, if I go down here, I'm losing $50 or something, then, you're making too much of an adjustment. It becomes directional in the opposite way, and you're also taking money out of the trade where you might not have needed to. So, I hope that answers that question.
It does. You kind of gone through the whole thing, and you kind of mentioned this a little bit, but how does the volatility or volatility regime, how high the RVX is or the puts are? Because, one of the things that you and I have talked about this, if it goes down, if the market ends up dropping, that put spread, that put debit spread helps you later in the trade, but not so much early in the trade because of the volatility. How does that come into play for you in terms of where the volatility range is and where it's kind of moved to?
Well, actually, I'd say for this particular trade, whatever happens in the first week is, usually if something happens in the first week, like a big move either up or down, it's going to affect the trade in, not in a negative way, but it's going to be, a little bit more work waiting for theta to come back into it. And partly that's because, like on a down move, the IB goes up. So it does, I do put put debit spreads close enough to the money when I put the trade on in the first place, so that if it does have a down move at the beginning, those put debit spreads do actually make some good money. Of course, there's so much time, not so much time, but there's enough time left in the trade at that point to where the bulk of the trade, which is the credit spreads on the put side, even though they're much further out of the money, they lose more. So, but that kind of balances itself out over time. It's kind of like there's just not enough I don't think there's enough time in the trade to where IV is making too big of a difference, unless you wait too long for an adjustment on the downside. But I don't worry too much about looking at this T+0 line drop below because of IV. What I tend to look at, however, is what my target exit date is. So in this case, anytime I get to an adjustment point or decide to make an adjustment or and plug in what strikes I'm going to do and what type of an adjustment I'm going to make, I always look and see how it looks, how it affects my target exit date. Is it affecting it? It might affect it great right now, what I'm doing, but is it better for me to pick a different strike? Is it better for me to do a different adjustment? Is it better for me to wait? Let's see what it does on my target exit date. That makes more, it kind of clears things up a lot more when I'm trading this than just blindly putting on an adjustment. Sometimes an adjustment looks like it's the right thing to do for that day, but then I'll look at where it is compared to my target exit date and find that it's really not going to give me much bang for my buck. So I have to choose something else. So I'm always looking at the trade twice. Today's date and my target exit date. And that kind of helps me to determine where my levels of adjustments are and what I'm going to do and which one's going to work best. It's not something like a black box thing. It's just something that, I don't have like a gazillion different tools of, trade A or adjustment A, adjustment B, adjustment C, like 10 or 20 of those. I only have like a few things that I use as adjustments that I think work with this trade. I think that you can have a whole bunch of extra types of things that you do. You can have butterflies and calendars and all sorts of things. I just like to keep it simple for me, and I think that just using debit spreads and actual calls and puts makes it simple for me, but that's how I kind of decide where I'm going to pick my, I don't know if that makes any sense. That's basically how I do it. I just really look at where it is today. Is it hitting an adjustment point based on where I think that I'm willing to let it roam off to, and how is it going to affect that? How is that adjustment going to affect what it looks like at my target exit date? Is it really going to help me? Do I need to do something else? Is it, it also helps me decide where those points are so that I'm doing it in a timely manner and I'm not doing it too soon. Sometimes it'll also tell me, hey, wait a minute, that adjustment level, if I do that, is going to be too soon. It's not really going to help me out that much. So I don't know if that explains that, but it's kind of every trade throws something a little different at me, and the reason why is because it's really a timing thing of what happens in the market. Is it going to throw me into an adjustment area on the first week, or is it going to wait until the second week? That's going to kind of affect where those points are. Wow, my guys are...
Okay. Amy, you ended up asking for about a 10-minute, it's 6 minutes after 5 here on the East Coast, so we have about 9 minutes left if you wanted to leave after 45. I just want to make sure you had enough time to go through the rest of your slides.
Yeah, I do have to... Calm down, guys. Okay. I do have to get going here in a few minutes, so is there any other questions that you want me to answer, or how do you want me to wrap this up?
There were a couple here. In an adjustment roll, okay, when you're doing a roll, Robert ends up asking, or are you adding to the position in example 2 that you just went through?
I'm sorry, what was that question again?
He said, when you do a roll, are you adding to the position? Like, for example, in example 2, when you ended up, did you have to do a roll? And when you roll, do you add risk to the position?
It depends on where, it really depends on where the rut is at that time, what time of the trade that happened. Like in that particular case, I guess it was early in the trade, I think, start of the trade, first week, yeah. So it just depends on what's going on in the market at that time. It's a timing thing of when it happens in the trade, and it's also a timing thing of, do I feel like the Russell is overbought or oversold, or does it look like do I think that it's going to continue to go up? What do I want to do? How does it affect, again, going back to, I always check to see how it affects my target exit date. Do I really want to add risk on the upside? For the Weirdor, the whole point of the Weirdor, if you look at the main graph here, is don't defend the upside too much, because 75% of the time the market's going up. And if I continue to add extra risk on the upside, it kind of defeats the purpose of the trade, of this particular trade. But that doesn't mean that I don't ever do it. It just really depends on what's going on in the market at that time and what time it actually happens during the cycle of that particular position.
Okay. John also ends up asking if, like on slide 7, after 3 weeks, do you ever consider taking off a portion of the trade, like, for example, the put debit spreads?
Yeah, occasionally I do, but what I find is, again, I'll take a look anytime I'm going to do something or think about doing something. I always look at, well, what's my normal target exit date for this, and how does it affect it? Is that a good idea, or is it going to put me in a bad position? I generally don't like to remove the main pieces, like the beginning. When I start off with the Weirdor, there's actually 3 main pieces, and there's insurance. And I don't like to remove any of those main pieces even before, unless it's like maybe a couple hours before, or maybe the night before, or something like that. I don't like to remove any of those pieces until I'm really peeling the whole thing off. And then I'll remove it, like, in sections. I'll get rid of the most risk. The credit spreads obviously have the most risk. I'll get rid of those first, and so forth. And what I find is that if I try to do something where, let's just, take some money back from these put debit spreads right now, that's generally when something might happen where I actually need them. So I just find that it's just not worth adding the extra risk to the trade. I also, in a Reg T account, it's really not going to matter very much, but in a portfolio margin account, it's going to make a huge difference on the margin I use. So that's another reason. I don't want to all of a sudden add to the margin that I'm using when I can be using it for something else. So, so I generally don't do that.
You talked a little bit about the timing of that adjustment. There were a couple of questions about timing. Can you explain a little bit, like, when you hit an adjustment point, do you make the trade exactly at that moment? Do you end up looking at the trades just once a day? Will you sit on it a little bit? Do you give yourself an extra couple of points if you go past it? How do you end up determining when you're going to put on that adjustment?
Well, most of them are alerts, and sometimes it's very close, especially on the downside. I'm probably a little more diligent about getting those on exactly pretty much where my alerts are. Might give it a little bit of wiggle room. I mean, obviously, it takes time to, what if I'm not sitting there staring at my screen the whole time, so maybe I get an alert and then I got to run and, take a look at where it is, and the market could have moved by then. So yeah, there's always a little bit of wiggle room there. I'm a lot more diligent on the downside though, but and then on the upside, I mean, again, it really depends on where the trade is, but on the upside, I tend to look at it more. Okay, I hit an adjustment area on my alert on my upside. Let's go take a look. Let's see what would be the best thing to do. What does the trade look like now? Does it look like it's in an overbought position? Maybe I'll roll, that kind of thing. So it's a little more thought goes into the upside than the downside. The downside I want to make sure I take care of so that I don't get in trouble, because that's that's the side that I really need to protect. That's the side that most of the profit's coming from this trade. And on the upside, I don't need to defend it that much, but I'll kind of take a look and see what's going on, and decide once it gets to that alert level what I'm going to do.
Amy, you've been trading this a long time. What were some of the things or lessons that you've learned from the trade, or some of the most surprising things when it comes to good risk management principles for the Weirdor?
Well, there's actually one of the most surprising things that I learned is, let's just take a look here. Back on speakerphone now that my dogs have settled down. One of the things that I've learned, so you can see in the graph here, this is like obviously the standard Weirdor looking graph. And as I explained, this T+0 line as time goes on. As you can see, it keeps rising up and rising up and rising up. And, you know, it does go above this expiration line. And if you wait long enough, it'll go a lot more above the expiration line. Not a huge amount more, but it'll look more substantial, especially on a, you know, large multiple tranche trade as opposed to a single tranche trade. But one of the things that I've learned is that this little area over here is obviously the, you know, a goal to get to. Like, wouldn't it be great if, as I'm getting close to the end of this trade, that the Russell ended up over here? And, you know, maybe I had an adjustment on, maybe I didn't because it happened later on in the trade. And all of a sudden I'm sitting over here, and this T+0 line is like, you know, already it's above this right side of the graph. It's sitting over here nice and pretty. I got a huge amount of profit. I've already hit my profit target, but I'm like either right at my target exit date or just past, you know, thinking maybe go past it. And I kind of think, wow, let me just stay in it one more week because then I can get this huge amount of money over here. And what I found was that most of the time it's just not worth waiting for that. So I guess that's one of the most surprising things. It's like, you know, where you think you're going to hit this huge home run, I think it's happened to me once. And was it worth it? Well, it pretty much doubled the amount of money of the trade, so it was a pretty big one. However, the other times that I tried to do it, it was a headache. It was stressful. It kept me using margin where I could have been using it for something else or getting into another Weirdor trade and getting better fills and better strikes. And a lot of times it just, what ends up happening too is that this T+0 line, once you start getting over there, yeah, it can be up here, but then it starts really sloping down quite a bit to the right. And, you know, it doesn't take much of a move for the rut to all of a sudden erase a lot of that extra profit that you think you're going to be getting. So I think that was kind of like one of the surprising things was, oh, wow, it's hit that spot again. Let me try to go for that big home run, and, you know, just isn't worth the hassle. So I'd say that was one of the biggest surprises.
Hey, Amy, I see we're right at 11 or 15 after, so I know you have to go. Jim just back in, I see.
Yeah. Sorry about that. My cell phone dropped.
Oh.
We've got questions that we're to answer, so what I'll do is I'll copy them and then email them to you, Amy, and then maybe we can paste the replies in the recording or something.
Okay. That would be great.
Thank you so much.
Thanks a lot, you guys. I hope it was I was able to answer all the questions that you know, or what you were looking for at least. And yeah, just send those questions off to me, and I will answer those and get them back to you.
Okay, great.
And if anybody has any questions about Amy's service, how it ends up working, its pricing or anything, you know, send the question to Tom or I. If you have specific questions about the strategy, if you want to end up knowing before taking a look at her service, she'd be more than happy to end up answering any questions that you might think of afterwards. So thank you, everyone, for attending.
Yeah, thanks, everybody. Talk to you guys soon. Bye-bye.
All right, thanks. Bye-bye.